This is my Vanna workspace that I use here on Volland. It's pretty simple, has just four medium-size charts and my little statistic over here. I'm going to step through one by one to show you how each of these widgets work and then kind of bring it all together to make a thesis in the end. The first thing on the list is the Vanna Heatmap. What this is showing you is each individual option's contribution to Vanna hedging for that day. So if you see these deep red strikes right here at say 5,600, that is contributing a negative $45 million daily hedging value. So this resets every day. This uses changes in fixed strike volatility and calculates how much notional each option needs to be hedged. This also helps identify the terms that fixed strike vol is strongest in. Typically, this rolls out in waves since term vol has a basis in realized vol. So it shows how the hedging changes. As an example, right now, you can see September 20th has pretty high impact. You can safely assume that soon, September 30th or October 18th, will have a similar kind of impact. You can use it in your trading by being able to pick strikes that might have become significantly cheaper or more expensive based on Vanna. For instance, if I zoom in here to July 19th, I see that this 5,600 strike has gotten considerably cheaper. A lot of hedging is down. If I come over here to the exposure, I see that 5,600 is a positive Vanna and is likely a sold call. Okay, a lot of sold calls here at 5,600. Now, if I'm bullish, that means that this has become cheaper for me, and I should be able to maybe buy these 5,600 calls and get a lot more return to risk out of them if my thesis proves correct. So this is a good way to pick your strikes if you're bullish or bearish over a certain term. As you can see, this might have gotten a little bit expensive. This is at the end of July. Oh, updating. This is at the end of July and has increased in hedging. This is a 53.65, so that's the JPM, I guess, right? Is that the JPM strike? There it is, 53.65. Volatility has gone up. Ah, there it is, right there. So volatility went up. This could probably be in a fixed strike vol scenario. This has gone up while the overall Vanna is positive right here. So that makes this a really cheap option right now, since it went against the grain of what the Vanna would be. So you should be able to buy 53.65 put if you are bearish. So that's how you can use the Vanna heat map. It basically just gives you an overall overview of how fixed strike vol is acting compared to the Vanna exposure at each strike. Transitioning over here to the exposure, this is showing you essentially a histogram of each strike and how much Vanna exposure you have at each strike. This is the same as what it was in the old Volland, where if spot vol correlation is acting appropriately, green strikes will be attractors and red strikes will be repellers. So this becomes kind of supportive if spot vol is acting correctly, and this becomes attractive right here. So it looks quite bullish. And the cumulative chart on a dealer perspective is also showing quite bullish because the aggregate Vanna is positive, and you can see that all that aggregate Vanna is above. So if implied volatility comes down, particularly up above, then we should advance in price as far as dealer hedging goes. However, for a while, I've been talking about how little put hedging there has been. People have not been buying puts. And that is reflected here in the cumulative Vanna exposure chart because it is down here. If people were buying puts, this would look more like a V, okay? This can be reflected right here in the Vanna Inertia number. So what Vanna Inertia is showing is it looks at how much customer force would be required to move the market in one direction or the other. And it uses this cumulative chart to do so, assuming dealers don't want to see an increase in Vega as they make less in that scenario on a daily basis. So how is this useful? Let's say there's maybe a decision or some kind of catalyst that you know that downside may have a chance at being realized. So you know that downside here from the customers will realize a better return to risk than the upside. And that's how this is seen. -1 is the smallest number that you will see, and that is extreme bearish, while +1 is extreme bullish. So if the market does drop then that means the dealers will be put in a worse and worse position, and they will assist in the drop all the way down to the bottom down here, probably around 5,100. And if it's gets much, much worse, it can get down to 4,800 here. However, if you assume that puts are going to be bought, then you would start to see this curve become more like a V. And when that curve becomes more like a V, you could start expecting a bottom. So that is also how to use this Vanna Inertia. This is showing you how the customer force will impact the market. So more bearish force will force the market down further, then an equal amount of bullish force would force the market up. That is what this is saying. This is also not a percentage. This is just comparison between single bullish and single bearish force. Another new feature on the redesign is this aggregate Vanna trend. There's several Greeks that we have the trend for. Aggregate Vanna correlates to bullishness from dealers. So if you see high Vanna numbers, 40 billion right here, this is very, very bullish. As you see it drop down, it gets more and more bearish. Over the past several days, I guess 4 days, we've seen bearish impulses, and we have seen that these aggregate Vanna numbers have matched, and they are getting lower and lower. Because of the dealer impulse being negative 0.65, you can see that there's not going to be much support. As it sells off, it's going to get worse and worse, and dealers are going to actually help it out. So to look at the market right now, I would say first that overall, because the aggregate Vanna is positive, that we are in a positive dealer regime, but probably not as strong as we have been over the past 6 months. If there is any catalyst that causes customers to want to sell, customers being vol funds, macro funds, anybody who is actively trading, the impact will be a lot greater if it is a bearish catalyst as opposed to a bullish catalyst. So the return to risk right now is bearish for catalysts. Furthermore, when I'm looking at the, if I think that there aren't going to be no bearish catalysts, and I'm looking at the heat map, maybe over the next month, perhaps a 5,600 call might be a good buy. If I'm looking down here, this is going against the grain. So maybe out here in July 31st, I might want to buy a 53.65 put, since it's going against the grain of puts. That is the purchase put, I believe, of JHEQX. So this makes sense that this would be green. It doesn't make much sense, so that it would be positive hedging from here. So that probably means that vol has somehow, for some reason, dropped at the end of July. And so this particular strike is on sale. This particular strike, we've drifted further away from 5,600 today. We are down 16 points. So this one, though, has dropped considerably compared to its neighbors. So this one is probably also cheap. Thank you for watching this video, and may Volland help you in your trading ventures.